You.
I'm just getting everything set up. Just give it a couple seconds. We're going on YouTube live, and so we can get the series going. This will take 30 seconds, and here we go. All right. So good afternoon, everyone, and once again, welcome to the KoreSummit Webinar Series 2021. My name is Oscar Joffrey. I know everybody's wondering who is this Oscar Joffrey, but you know what? I'll leave that to a later moment. You can Google me. There's even a statue about me, so I'll leave it at that. But listen, today I'm glad to have two colleagues. You probably heard us having a little chit chat here, and we're gonna have a great conversation like always. Now you get the format: 45 minutes of talking, 15 minutes of kind of Q&A questions. If you have any questions, there's a little hand there that if you put your hand up, boom, we'll be more than happy to bring you in and ask the question. But before we get started, I'd like to have our panelists that this afternoon introduce themselves. So Chris, let's start with you.
Hey, Oscar, thank you so much for having me. As always a pleasure to be on your webinars and really looking forward to this conversation with you guys. So yeah, my background, my name is Chris Lestrino. I'm the founder and CEO of KingsCrowd. In one line, we're kind of building the first kind of Bloomberg / Morningstar rating and analytics service for the online private market ecosystem. Our goal is to provide investors with independent, unbiased research on pre-seed to pre-IPO investment opportunities across every one of the online private marketplaces, from places like WeFunder and Seed Invest or Republic, all the way up to the Forge and Shares Post and the Equities ends. So that's the solution that we're building out. Today, we're at 100% coverage of Reg CF deals. We're at about 50% coverage of A+ deals, and we're continuing to build that out. And we're really excited about the solution that we've built to date. Us ourselves have raised $1.7 million across Reg CF and 506C. We have 12 full-time team members, and we've grown to over 350,000 subscribers across our multiple products. So anyway, really excited to be here and discuss this very, very pertinent topic.
Perfect. Excellent. Andrew, people know you.
People know me. My name's Andrew Korn. I'm the founder of E5A. We are a systematic data-driven investor acquisition firm. My background includes writing IPO roadshows, building an agency, selling it, working in financial publishing on the marketing side, and then switching careers, building a multi-factor model, managing equity portfolios, designing ETFs, running a small hedge fund, selling that company, and then worked for a bank where I was chief investment officer, and then switched back to marketing. So we basically market financial products and also work on cap raises for real estate and for Reg A+, Reg D, and then, of course, recently taking on Reg CF now that it's going to 5 million. But also in my sordid past, I was as a CIO and portfolio manager, I actually published a lot of buy-side research. And you can find it, it's still on the Barron's website. I'm actually still on Seeking Alpha, where I have a mere 198 posts, although all of them are old because I don't do that full-time anymore. But anyway, really in on research. Bloomberg actually hit me an hour ago, seeing if I want to buy yet another Bloomberg terminal, which I don't. But I love having access to them, and I love what Chris and his firm are doing. So,
thanks, Andy.
Perfect. So we're gonna have, so look at that, two lovebirds. Okay, so they like each other. Damn it, I didn't expect this. I wanted to have a little bit of a friction. Friction is always
up
good
on you, Oscar.
I didn't see that coming. So, all right. So for today's topic, I mean, it is now becoming the topic of conversation that years ago, it was either too early, there was no reason to discuss it, or at least it didn't have any wheels there was nothing there. So good idea, but like all good ideas, it was just either too early. But now we're in a different state. We're in a different state when it comes to research. We're seeing different types. So before we dive into the value of research, I think it's important for the audience to understand the different types. So obviously, Andrew, you got one background. You came from a regulated environment. And Chris, I'm going to start with you. So the approach that you're taking for the research you're doing, if you can walk us through that part, just as an overview.
Yeah, absolutely. So, the approach that we're trying to take is to create a solution that makes the private markets that are now accessible online to retail investors and any institution that, isn't necessarily a VC or PE shop, the ability to invest with confidence. And the only way we're going to be able to do that is if we make these markets feel like the public markets. So what makes the public markets go forward? Well, it's having access to your Bloombergs, your Morningstars, your Wall Street Journals. All of the news and research and data that's available on the public markets is what gets people to actually take action and invest. So when we built the WeFunders and Republics and the Seed Invest of the world, while that was wonderful, the reality is they're marketplaces and they're not really in the business of selling securities or providing lots of research. Their goal is to put up companies, make them available for investment, and accept cash in exchange for equity. Our job in this market is to fill that gap. It's there to help independent investors figure out what they should be doing, where they should be looking, and look at the key criteria of each one of the potential investment opportunities they have in front of them. So the way that we do that at KingsCrowd is we focus on being an independent ratings provider that looks at 100% of the universe of available opportunities that exist to invest in. We don't take any money from the startups. We don't take any money from the platforms. We work wholly independently with the idea of providing you a comprehensive worldview of all of the opportunities for investment that you have available to you. And then what we've done is we've created a tailored rating system for looking at these types of companies. Clearly, if you use Bloomberg data or Morningstar ratings, it would simply not apply to early stage companies. So what we've developed is a proprietary rating system that's fully data-driven that looks at all early stage companies in the exact same way. So we collect over 170 data points on every one of the available investment opportunities that's out there, utilizing the Reg CF model. Everything from past year's financials, income and balance sheet, valuation, terms of the deal, how many investors are investing, the market they're in, the founder's experience levels, et cetera, et cetera. We take all of those data points, we ingest them into our system, and then basically benchmark all of the available opportunities against one another to come out with a report that says this scores a 3.5 out of 5, which basically tells you, hey, they're kind of in the middle of the market across these various dimensions. And we break down each component of an early stage company, from the valuation to the market opportunity to the founder's experience to the differentiators and the performance of the business. So that's what we're doing, is creating a comprehensive report that allows you to look and compare every one of these investment opportunities in the exact same way so that you yourself can make an informed investment decision.
Okay, and thank you for that recap. And just, again, this is not for no other reason, just to be clear, I think you stressed it there, that you're not getting paid by the company, you're not getting paid by the platforms, you're doing it independently of that because you're using the First Amendment as a way of producing this report to the general public. And this is an important aspect that those who are listening in, when it comes to them, we'll get a little bit more deep into that. But Andrew, you're on the other side. You come from the fund world. You come from a world where everything has to fit within the boundaries of the SEC and FINRA, and research has been critical. So now we're bringing it into the Jobs Act with Reg CF, Reg A, and there's the other side of research, right?
Yeah, so, I have many questions. For Chris, do you have a pipe directly from the different platforms?
So we have a pipe directly to the SEC Edgar filing websites. That's where we pull in all the deal flow. Great. And then we go and collect additional information through our own private equity research. Yeah,
because last count, there were like 65 CF platforms. I think now there's closer to 90. Yeah. So that is an important thing. So, you were doing this, I think, a really good way quantitatively. There's no bias involved, et cetera. But unlike public companies, because I've done this exact project before, having built a multi-factor model, it certainly worked better on large caps than it did on small caps for a variety of reasons, some of which I'm about to quiz you on. So in a good-natured way. So, if there's a company with revenue and one that's pre-revenue, will the revenue company rate higher?
So it's a great question. And the way that we built our models is we look at early growth and late stage organizations. So early is your pre-seed and seed, where the vast majority of the time you're not going to see revenues, or you're going to see very little revenues. Growth stage, it is going to be much more looking at those types of aspects. And what we're doing is we're starting with a generalist view, where you look at all companies within that kind of similar stage of business. Where do they stand on these key components? But over time, we'll create more divisions, ratings where, hey, a biotech we recognize isn't going to have revenues for years. It's going to be more about looking at what stage of development are they at, what phases of clinical trials have they made it through, and create a more nuanced view of the world. Now, to start out, it's simply to help people understand, where does this company stand in relation to that other company? So they'll be able to see what their revenues look like, what their monthly burn rate looks like against those other companies that are out there in that pre-seed and seed stage territory. We've created some mechanisms for weighing those who are actually generating revenues versus those that aren't, to not hit companies that are pre-product and look at them a little bit differently. So we have created some mechanisms to dilute the value of necessarily having revenues in those really early days. That goes away as you get to later stage companies, but for the really early stage ones, kind of part of our mechanism is recognizing, hey, this is pre-product, which increases its risk level, but in reality, they shouldn't necessarily get dinged for not having revenues.
So how do you judge experience, especially in the pre-revenue companies?
So one of my favorite things, and it's funny, probably some of my worst investments in life have come from backing people with really interesting ideas. There was one, it was a Y Combinator backed real estate tech company. The guy had no experience in real estate. And guess what? They failed. And a lot of people who don't have experience in their industry trying to hop in and innovate and break the model oftentimes don't know enough of what they're breaking might actually be essential and needed. And so the way that we look at experience is, how many years have you actually spent within the industry you're working in? And do you have any exits or former successes of companies that you've started? So we use that as kind of our initial gauge to look at the actual experience of the founding team. Other data points that we collect: what university have you gone to? Have you worked with the other founders on the team before? How big is the team? How long have those team members worked there? What do their experiences look like? So we're collecting a whole ton of data points around the team to understand what the actual experience level is for that industry, for that sector, for that capability.
Interesting. Because a lot of times with startups, and I'm a fairly active angel investor, and I made my first Reg CF investment week before last. And
Nice.
I'm sure it won't be my last. But in that Reg CF investment, they had come to my agency looking for us to help raise money. The raise was too small. The cost of capital would have been too high engaging a firm like ours. So we said no, but if you come back and want to do a Reg A, that would be great. But I really got to speak to the CEO for a while, understood the mindset, dug in way more than what would be on an offering page, and also met their head of marketing, who on paper isn't all that experienced, but had related experience I had a lot of respect for, and also innate intelligence that I was able to really quantify through conversation. So it's hard to do that when it's just strict quant.
One thing that I'll kind of throw in there, the way that I tell people to utilize our product at the top level is we are a market scan tool. There's over 400 available investment opportunities right now across 50, 60, 70 plus platforms, right? Just the idea of trying to manage to go and find all of those opportunities and then dig into each page and to figure out, where you can find the opportunities you're interested in, the industry you're in that are actually good quality. That's a lot, right? So our tool right off the bat, you come and you say, I'm interested in B2B SaaS. I'm interested in companies that are below a certain valuation, and I want to see the companies that are scoring highest. And now you get your universe from over 400 available investments down to maybe 10. And then you can dig into each one. And then what we say is, well, go off and do your own research. Go do additional diligence. But now you have a much smaller universe where you feel good about the 3 opportunities you're looking at, not the 300. But then going off of that, one other thing that we do is on about 50% of companies, we actually initiate a deep dive diligence. So we essentially say, hey, this is an interesting company. The data was really interesting. Maybe it scored a 3.7. Which isn't the best score, but it's pretty good on our model. And we say, but there's something really interesting here. Let's go talk to those founders. Let's spend extra time with them and do a deep dive. My whole background is private equity diligence and venture capital diligence. So I know how that process works. our whole team is ex-VCs. We have, I don't know, 6 or 7 full-time now that just do investment research. So we have them go off and do the work and talk to the founders and learn more about the deal. So you're right, there are components that you're not going to capture, but what I'll say is, with Morningstar, the way I used it as a kid growing up, when I was investing in stocks, I'd go on my Merrill Lynch account, I'd say, I want to see these industries and I want to see all the 5s and 4s. I didn't invest in every one. I invested in probably 3 out of every 10, but my universe became so much smaller and so much easier to digest.
Yeah, so using it as a screening tool and as a scoring tool sounds like that's really useful. And starting with a number like 400, which isn't the biggest universe in the world, but for private investing open to everyone in the country, which Reg CF is, I would say that's a pretty nice size universe. So using it as a screening and scoring tool, I think, is great, and then digging in deeper. So you have a team basically of, as you said, ex-VCs or consulting, so they understand both operational due diligence as well as the investment due diligence. And so do you guys write reports on those companies, or do you just adjust their scores?
No, we initiate coverage, like I said, on about 50% of companies, and we basically have kind of that strong buy underweight model that's utilized in the traditional public equities world.
Sure.
And so that's where you get kind of a full in-depth report. And essentially what we do is, for all those early stage companies, if it's price, if it's market size, whatever, we go into kind of a deep dive about each component. And then we kind of have the bearish and bullish outlook and an executive summary. And then in addition to that, for a lot of those companies, you'll find a link. We'll actually link you to a founder profile where we've done a Q&A session with them as well. We do that outreach. We say, hey, this is a company that's made it through our process and is worth having a conversation with.
Do you get crying phone calls after you publish?
We don't actually. So we're really good about the process that we take. We've been very careful throughout this whole thing to be respectful and recognize that these are all founders just trying to make something happen. Our ratings are behind paid walls. You have to, pay to actually access that information. And what we find, the behavior on our platform is less of a, we're going to pull money away because we said this was underweight. And it's more of a, people will probably end up investing because they find an exciting opportunity that they otherwise wouldn't have found. It's more of a discovery tool than a detractor tool. But the reality is we're very respectful and thoughtful about the approach we take. By creating a structured process that calls out all of the components, we make it much easier to kind of reflect that, hey, we're taking the same process with every one of you. We're looking at you in the exact same way. Worst case scenario is you're kind of at the bottom of the pile and you don't get filtered up to the top. But it's not necessarily going to be this massive ding against you. If you can't work beyond that, there's probably a bigger issue. But I've been very surprised. We've had very, very few people reach out and even have any concern.
Right. So I used research. We would publish essentially, hey, we would not only do we own this in our portfolio, but we would buy. And we would also do, after we would sell or when we were trimming, we might write, well, we always publish research, usually just to our clients, but sometimes we would share that with the outside world as well. But our revenue model was assets under management. With all the work you're doing, quantitative, qualitative, what's your revenue model?
Yeah, so we're a subscription, basically SaaS license fee business. And the way that we sell is very much the Morningstar model. We sell to individuals on a lower cost subscription fee, anywhere between 10 and a couple $100 based on the level of access you need, the number of deals you want to invest in, et cetera. We sell to institutions, wealth advisors, family offices, RIAs. Those are more expensive products because there's more handholding, there's more integrations with their services, there's more data reporting requirements they have to be able to tell their clients about the deals they're investing in. And then the big opportunity, and I can't get into who the institutions are, but I can tell you some of the largest public equity data providers want to partner and have a solution in this space. And a lot of the big public brokerage account providers want to build solutions for retail investors in private equities. But guess what? They need a third-party rating provider licensed in to reduce their liabilities and also provide a level of education and research to their end user.
Cool. Why don't we let Oscar get a word in? I'm not sure why, but I think we should.
I don't know why either, because I felt like you were just going to grill the poor guy. I mean, the guy's in the corner there and you're like,
I'm throwing him softballs here, Oscar. Chris, am I throwing you softballs or what?
Total softballs.
Total soft. Wow. Okay. No, that's good. No, I mean, look, it's the one part that I think it's good that we kind of flushed out what you're doing on your end, Chris. Obviously, there are other types of research that's emerging, that's coming from the broker-dealer community, because, and I think the issuers, the companies that are listening in right now, or any listening to this, we try to make it clear that research can be a good asset. And the reason why Andrew's here is because he's in the investor acquisition. So I'm really curious from your end, before I go to my next question, how do you feel about research? I mean, you're helping a client right now raise 50, 75 million. Obviously, Chris's team is doing they're getting it directly from their Form 1A. And obviously, the company you're working with can't have any interactions here, because at that point, that company ate it. It owns that report. You must will. So the further it stays away. But do you think that will have an impact in your primary capital raise in a positive or negative way?
So it does, and I think it'll be more positive than anything else. One of the things that we would do in a situation with a firm like Chris's is to make sure that they have all the information, that they have a real complete picture. So if we were working for a company and we were not 100% happy, 3.7, why can't we have a 4.2? And here's why. We would definitely go and make the case, but we would do it legitimately with, here's information that you may not have access to. The thing about E5A is we are kind of the masters of saying no to issuers. And the reason for that is that we screen our issuers. We get lots of referrals. We don't say yes to everyone because we want to work with very high probability clients who have a good track record, who have strong management, have a great idea, and are addressing a market that needs to be addressed. So with that, hand in hand goes research to support that I was right in my selection, which, I'm hoping that would be underscored. But so far, we've only talked about Reg CF. And Oscar, you just said, let's up the game and talk about Reg A+.
Yeah, I mean, Reg CF, I think it's still just as critical in Reg CF. I mean, you're going to get a different type of company now that their filing may not tell you everything. I mean, I know, Andrew, you and I have seen companies that raise considerable amount of money, which is under Reg D. That information may not be available. Now they're doing a Reg CF. They only have to give a little bit of information, and all of a sudden you're going to do a report on them. I'm really curious about that. But then, of course, the Reg A. I mean, the Reg A is really, I really believe that there's, so maybe we'll take it in two steps. So let's talk about that kind of hop, the 1 million to 5 million. How will, even though the research may be positive, how will the data be gathered? And I know you'll still be using the same techniques as you're using now, but some of that information may not be available because this company historically have been, fully operational for 10, 15 years, right? They're not disclosing that openly. They're only going to disclose whatever's on the Form C. Could I be wrong on that?
So, I mean, the reality is you still have to provide the last 2 years, right? And past performance is not an indicator necessarily of future performance, but it should hopefully at least give you a sense of where that business is today in the near past. And if they had a rocky past or an excellent past, and now they have an okay, somewhat current period or a not so good current period, either way, we'll get a sense from those past 2 years financials, kind of where they stand and what things look like. And then this is all about context, right? So obviously the company is going to give you a good amount of information, but the reality is you need to go off and look at, well, what are the valuations of companies that are at a similar stage raising capital at? And are they above that? Are they below that? And if they're above that, how are they justifying it? Is it a really experienced team? Is it because they're a first mover? Is it because they've had amazing performance for the past couple of years? What is it that's leading to them, having this higher valuation or whatever it may be? So it's looking at the broader market context and being able to take the data that we do get, which by the way, is much better than you would get in a traditional venture capital world, and utilizing that to our benefit to create more context for the investors. So I don't think the process will change. We have to work with the data we get and then what we can build on top of that. But I think it's much, much better, frankly, than we've ever had before.
Yeah, I think
Yeah, no,
I
sorry.
think part of the question that Oscar's getting at is right now it's a level playing field. Everyone's raising between $0 and $1 million.
Oh, sure.
March 15th comes, bam. Now
Yep.
we're going to have all these companies raising between 2 and 5 as well. The nature of the raise is different.
Yeah.
The nature of the firms are different. Is that going to
Understood.
change
No,
your
great
algo?
Great question. So that's where basically our rating system, early growth, late stage, right? So growth stage is looking at Series A, B, C type companies. So we know we're going to see a lot more Series A come, and even Series seed or whatever people want to call it, where they're raising a $3 million seed, a much larger round of funding. So the way that we're set up is to be able to look at the nuances of stages of companies, and we may become even more nuanced if there's large enough buckets of companies that want to raise a Series seed, not necessarily a Series A. So we will compare and contrast companies based on their stage. The reality is, in a Reg A plus, while there's a lot more disclosures around risks and whatnot, I mean, from the financial standpoint, okay, you're audited at a much deeper level. But the reality is you still get the revenue numbers, you still get the COGS numbers, you still get what their gross margins look like. So you should be able to somewhat be able to do an apples to apples comparison if they're both Series A and one's raising 10 and one's raising 5. You should be able to get a general sense of how they compare.
Yeah, so we already have a client, they're doing a $5 million CF and a $75 million A. They're both going to hit within weeks of each other just because it takes longer to do the A. The only reason they're doing the CF is so they can raise 80. It's the first workaround I've seen. We're not even at March 15th yet. So, a company like that, their financials, their balance sheet, their management team is going to be so dramatically different than a company trying to raise $1 million or $1,070,000.
And they wouldn't be bucketed with those companies. We wouldn't rate them one-to-one.
So you guys have a lot of work to do to prepare for this.
We do, yeah, absolutely. That's why we're continuing to hire and raising our own capital.
Well, that's what see. That's what I'm wondering. Like, I'm seeing this, and then right now the data that you're getting, it's from the funding portals. And maybe you haven't seen the other webinars.
It's not from the funding portals.
I know, but there's a new dynamic.
You're absolutely right.
No, not
just automated systems for the filing systems to pull in that data. We've done a lot of things to make sure that we can handle the scale as A+ does play a large role, as CF does play a larger role. And even a lot of the platforms or the back-end platforms and issuance, things like that, are providing us their API so that we can more easily track those one-off pages for various companies utilizing the A+ mechanism.
Well, I think you need a pipe into the transfer agents is really.
Yep, that's exactly right.
Well, yeah. What a nice guy you are. No, I'm wondering one basic thing here. The data, today with the funding portals and the Reg CFs, it's easy to pull it. We're bringing a different dynamic now into Reg CF, as you alluded to. It's now going to be done by a registered broker-dealer. That's one big difference. On the Reg A's, from a funding portal is one source, but 99.99% of the deals are not being done there. They're being done on the individual websites, and quite often it's not the website you think it is. It's usually a dedicated environment.
We know, I won't get into it, but we know all about kind of the back end workings, a lot of these A+ and how we're going to start tying into them. So that's fully on our roadmap and being executed on as we speak in order to be able to support this new environment that does have things, a lot more spread out, which frankly, fortunately for us, just increases the value of the service that we're providing.
Yeah. Like I said, I'm in favor of reporting, obviously, research, because there's another element that's now arising. It's in the primary. I'm obviously invited Andrew today in this conversation because Andrew is dealing with the clients right at the get-go. They're strategizing their social media and all these things. And, like a public company would often have somebody there dealing with what we call crisis management, just in case something happens. In this environment, that doesn't exist. So, which means that whether they report good, bad, or ugly, whatever it is, how companies will deal with is really, because I know the tendency of a CEO, right, is to go, we had one case of a CEO who immediately saw that reporting, wanted to tell people about it, and we say, no, you don't say anything, just leave it alone, because it's in your best interest not to say anything. So it's kind of, whether it's good or bad, it doesn't really matter. It's better to be fully independent of everything. So it's really an interesting dynamic, and I'm really curious to see how the investor acquisition market will address it. I guess that's why I'm trying to figure out, Andrew. I'm really trying to. I'm for myself as well, right? For all the other entrepreneurs, how will this impact my company if somebody's doing an independent research on me and without my knowledge, in which they can, because it's a Form 1 filing or Reg CF, which they can, and then boom, this comes out and I've spent 50, 100 grand ready to go.
So I kind of have a two-part answer here. So one of the services that we provide in an A+ is packaging. So of course we're packaging, we're building the offering page and all the materials that people are going to be exposed to. Emails, advertising, social, we work very closely with PR firms, etc. But one of the things we do that's a little more behind the scenes is we put a deck together. Because what happens inevitably is through one part of our media outreach, we'll get a whale. We'll get some kind of enormous investor that is very interested in the company. They want slightly better terms than the Reg A, and they're willing to write $1 million check. So we need that packaging done in advance. It can't be done last second. So a deck like that that's put together, which is, although promoting the company in the best light, is still highly unbiased, meaning there's nothing there that's not immediately defensible, is also used with what I'll call the qualitative newsletters that are out there. Because what we're not talking about are some of the newsletters that write independent research, and when they publish, people take a lot of money in the next day and the day after. And sometimes for weeks. And several deals have really been enhanced, including one of my clients who's taken in actually millions of dollars through being in a couple of these different newsletters. So we make it a point to make sure that that typical deck is ready as if it's ready for an analyst, as if they were sitting down with a major investment bank, and they would have that deck ready to sit and go through it, go through the story, the financials, if they're allowed to show projections, or at least what is the vision of what the next 2 to 3 years look like, especially when funded. So one of the things we didn't talk about is this other end of research that is a reality and is out there. And I think a lot of the, Reg A's are going after that as well. So, being prepared for that means that you're prepared for a lot of other situations, including saying, hey, Chris, we're raising 25, we're raising 40. Can we sit down with your team proactively and let them know what we're doing? And that may be a way to go. How is your team? Are they receptive to that if someone were to call them and want to?
We typically like to go through a process and then do the outreach, again, creating that element of independence. And we do, there are people that reach out and say, hey, and so we kind of say, listen, we appreciate you putting it on our radar. We go through our process and we'll be in touch if there's interest. So again, just trying to create a standard for everybody so that we follow the same path for everyone. And that puts everyone on equal footing and in a good place. And honestly, people always respect it and say, hey, thanks for taking a look. And to your point, Andrew, I think I mentioned this a little bit earlier, but so many of the groups that are thinking about investing in this market. So one of the wealth advisory groups that's becoming a client of ours, $4 billion wealth advisory group. They have younger clientele, and the younger clientele are clamoring to be able to invest in more startups and whatnot. And basically they're like, we're not set up to see a ton of deal flow, and we're not set up to do the diligence. So if we could have automated deal flow from all of these platforms, and you could provide the diligence at a somewhat cost affordable level to what traditional work would be, that's a real value add for us. That's something unique that we could do at our firm. And that's a group, though, that literally was not going to partake or deploy any of that $4 billion into this startup ecosystem unless they have research. And so what we find is that research really activates people to take action. And not that we're making them take action or anything like that, but we're providing them the research they need to feel confident to want to take action. And so I think for startups and companies trying to raise capital, they just need to recognize we are a part of this ecosystem. We can help add value. We don't necessarily need to detract. If you don't want to talk about it because you didn't get a great rating, you're probably going to be fine. Go out and find the people who will, invest in your deal anyway. But for those who just literally won't partake unless there's research done, well, now that group's been activated.
All right. So one thing that I'm going to need to just kind of clarify for the audience, if you are marketing a CF or a Reg A, do not waste your time going to independent financial planners or wealth management firms. There's something called selling away. So a financial planner cannot recommend you to their clients because the assets leave their doors. If they were to put together an SPV, if they were then to get a CUSIP for it, so it was on their custodial platform, then they could put a bunch of clients in it and still, quote, have custody of the money, even though the cash has left the door. The same way they do when they buy an ETF or a stock. The cash actually leaves the door, but they're able to track it and have all that responsibility for it. So you must be in a highly unique situation with that wealth manager where they're doing things to make it so that they can do that. But I just needed to clarify that for the audience because I don't want them all of a sudden chasing Merrill Lynch brokers.
No.
And it's near impossible to get on that platform.
Yeah, no. There are certain groups that actively create their special wealth advisory groups to do unique situations and asset planning and whatnot. Yes. And those groups, again, though, we're not going to partake in this space. But now they're like, hey, if we have a research component, we can show our clients. It's still up to the clients to decide what they want to do, but it's now being provided to them. It becomes, all I'm saying is we're taking people from the not acting world to the acting world. But I completely agree. Do not go chasing down your financial advisors. That's not going to get you where you want to be.
Interesting component. So we've gone almost full circle around. So, so as an entrepreneur, they're probably sitting back wondering. So one, what is critical here is one, to stay away from the independent side of it. The one that we didn't touch on, and we can touch on it lightly. Obviously, there are providers that are. These are where the broker dealers are providing the research, right? So this is a bit different, where this is a broker dealer. They're not using the First Amendment to do the research, and in this case, the company can engage with that rating. And so again, I'll come back to you, Andrew, because again, you're dealing with a company head on. How do you deal with that one versus a one that's completely independent?
So I'm going to say I don't have experience with broker created research on a Reg A or on a CF. What I do see are brokers performing due diligence before they take on a client and market their securities. But I would say way more out there is a CrowdCheck report. And you'll even see on a Reg A Plus the little CrowdCheck bug on the bottom of the page. I very proudly put them on myself. And I think there's a trust factor there for those that know the firm, that if this group of attorneys say that this company is sound, that there are no bad actors and that there's nothing nefarious going on. They're not doing what Chris is doing. They're not saying this is a great investment or this isn't a great investment, but they are saying that it's sound and that there's, there are no criminals. There's no criminal activity that can be found. So, but I'm not positive what the broker dealers are doing. Some are relying on that research. Some are doing a little bit more research. Some of them get involved in valuation. So, when I warn this is a big change with Reg CF, a company comes to me, they want to raise 20 million with a Reg A. I see their pre-money valuation is 20. I'm like, oh, so you want to sell half your company? No, do a $5 million CF, hit some milestones, raise your valuation based on meeting those milestones. Then let's do a Reg A and raise the other 15, or maybe raise 25 now that you have a better valuation. So I see broker dealers getting involved in that along with firms like mine. Keep in mind, I'm not a 79, I'm not a 24, meaning I'm not registered. I'm not a lawyer. I played all those in plays though. So that gives me a little credibility. But having seen a lot of deals, we'll make recommendations like that and then send them back to the broker dealer or back to their law firm to figure that out. But we don't want to see founders go and screw themselves. So
Yeah,
And
I
Andrew,
think that sorry.
one thing,
Go on.
one thing I was just going to say is we are starting to see more in the A plus space. I think especially now that the limit's going up to 75 million, I have seen more outreach from, boutique investment bank, basically broker dealers. And, they're approaching saying, hey, we have data room for 3 companies we're working with. And, they're mentioning things like that. And I haven't engaged any of them. But what I can tell you is it does appear as though those individuals are moving into the space. And the world I came from, the private equity diligence world, they're setting up data rooms, they're putting their information in there, they're putting their decks in there, and essentially, trying to run that investment bank-like process.
Well, I have a comment on that, and I think it's an important one. So where in Reg CF, we don't see the problem. Reg CF, even though they increased the limit from 1 million to 5 million, it's still a privately held company, right? That is a distinction that just can't be. So in Reg A, you got to be a little bit more careful because, it's a different entrant that can also participate. And for them, anywhere they can sneak a little research here and there, we don't deal with those kind of clients ourselves. So just so everybody understands, we draw the line with, privately held companies. We don't touch anything else about that because for me personally, I don't know how I can provide any value to anyone because your price is your price out there already. I don't know what you could get here. I mean, I know,
Right.
Andrew, you can help public companies. I just don't, from our end, I don't know what, but I do know they know research. They live on it, right? Because they're publicly traded. Any type of research they can get their hands on. Private companies, we're naive, we're young, we're going to make stupid mistakes, meaning we're going to contact you by accident, realizing that we should stay away. Where they're coming at you and say, hey, listen, you do a report, we'll pay you 10, 15 grand, we'll give you stock, we'll give you options. They're, and I think this is where the muddy waters are going to become.
Yeah,
I don't know about you.
Well, a lot of that already happens in the microcap world.
Yes.
And all they have to do is put a little disclaimer that they paid for the research. My firm stays as far away from anything like that as humanly possible. And when we meet people in firms like that, we immediately all go take showers. So that just kind of lets you know how I feel about that.
Yeah, and we're the same way. Our thing is, not only we'll definitely go take showers on what you just mentioned, but anyone, even all of the offering pages, we never take a founder at face value. Look, all founders have good intentions, but they're all going to tell you the greatest and best story of all time. And the reality is we're not all in multi-trillion-dollar markets, which seems to be the new thing to do, is just say you're in a multi-trillion-dollar market. So we're very much about taking our own worldview, going and doing our own independent research, because reality is there will be muddied waters. People will come into the space and not be the best actors. And we want to kind of steer 100% clear of that and get you on a good track.
Yeah, it's and we all need to be aware of it, that in Reg CF, we know they're all privates, and the other one is just going to be a little muddy. And I agree with Andrew. Sometimes that's how I feel. I just don't even know how to answer the questions, to be honest with you, because I often ask. For me, I go, so what is the value you're going to provide that investor that is already, your shares already trading? So what are you going to give me? Your shares are trading on a nickel. What am I going to do? Buy them at 2 pennies, a penny? And not to discredit them, but there are some legitimate publicly traded companies. But unfortunately, like any market, you're going to get the top, you're going to get some in the middle that are going to wait it out, but you definitely get the ones at the bottom, because the bottom is looking for, capital, right? Constantly looking for capital all the time, and whatever they can. And research is, anytime they'll pay research, it's golden. So I think the conversation that we're having today is just going to continue. And so from my end, the recaps are very simple. We're in the early days of it. King's Crowd is emerging, providing independent. So far, knock on wood, everything's gone great. You're expanding the research and the points of that data collection. And as Andrew alluded to, the client is changing, right? The $1 to $5 million raise is going to fundamentally change that client, which again, it will just hopefully over time, once again, it will be improving. But I think from an issue perspective, before you start jumping in, my feedback to them, I'll leave each of you to what your comment is do not embark on it unless you have spoken to all the partners you're dealing with in your offering, because, and I say this always, in Reg CF or Reg A, it's a team sport. You're going to have your lawyer, your auditor, your funding porter, your broker dealer, your investor acquisition, your transfer agent. This move could eventually make them disappear, right? It's typically what it could do, because everybody will judge the risk associated with it if they weren't aware or they weren't consulted with, because they're consulting with the client at all times. I love to hear your comments on that, Andrew.
I just want to give a word of caution to issuers on the allure of using Reg A Plus to go public. So I spent 9 years as an equity portfolio manager, and I designed the index behind, or myself and my team designed the index behind 6 exchange traded funds. Currently, depending upon the week, ETF trading volume is between 28 and 42% of the entire market. So if you decide that you want to go public, keep in mind that most public companies, the vast majority of them are on the OTC. They're not on the New York or the NASDAQ. The vast majority of them don't trade in a typical day. There are New York Stock Exchange listed companies that don't trade. There are NASDAQ companies that will not trade today. So all of stock basically is a demand market. Price discovery is based on what someone will pay, then I know what I can sell my shares for. Or I want to buy them, what is someone willing to sell them for? So if you're going to go public and you're going to be small enough that your market cap is not high enough to be in an index tracked by an exchange traded fund, I advise you to think 5 or 6 more times about going public. So I'd love to know what Chris thinks about that.
Amen. I said maybe 10 times. You should think about it even more. No, it's a terrible idea, and I would advise struggling again. Well, no, I'm not going to advise anything. That's not my position. But my opinion would be I would never do that to go public. But regardless of that, getting back to kind of our core discussion here today, this market, why I'm so proud of it is that we didn't just leap out of the box, and CF didn't just blow up, and A+ didn't just blow up and become this, multi-billion-dollar market. It's been a little bit of a slow burn, but I think in that happening, what we've built is a really strong foundation and infrastructure. And one of the key reasons all of these regulations pass that are improving this market is because we've built trust, we've built transparency, we've had success, and we've shown that there's not crazy fraud and all these things occurring that you might see in the crypto market. We've done a really good job of building this market on trust and integrity, and we are so much a part of helping to usher that into this space. And we think it's so important for the entire ecosystem to have all the parts, trustful, marketing agencies and broker dealers and platforms and issuers and researchers. And, I always joke about this, but 1 million people have partaken in this market to date. There are 330 million Americans that now have access to this asset class. We have 329 million more that could partake. And the reality is a very small percent have, because there's a lot of fear, anxiety, misunderstandings, not knowing what this space is about. And I think that's a good thing. Taking caution coming into this market is very, very important. And the best thing we can do is provide as much education, as much research, as much training. My favorite thing is when I hear from our clients, them using our lingo, talking about, oh, well, it's a safe, not a convertible note. You know what? I know I should maybe really look into X, Y, or Z because of that. And I love when I hear these people that had no idea, but were interested and intrigued, take the time, read through our 400 blog articles that are all focused on education, and then come to us excited that, now they're making their first handful of investments because they feel empowered to do so. And so we are all about just building trust and integrity in this market and helping to usher it forward in a way that we all want to partake in and feel good about. And that's our role here. We're here for the investor. We're not necessarily here for the issuer, but that's okay. You need someone like us in the market in order to help usher in more investors wanting to partake because of that education and research component.
Yes, so we too are very committed to education, which is why I'm on this webinar, and why I regularly have coffee over Zoom with Oscar. We're on the other side of the same coin, though. We represent the issuer. Our job is not just to acquire investors, but it's to complete the raise. Now, legally, we do not raise a penny. We lead the horse to water and we convince them to drink, meaning we bring them to the offering. We try to convince them of the offering, presenting factual, non-exaggerated, completely compliant reasoning. And then a broker dealer raises the money, which happens when you click the invest button. But that is what we're here for. And the other part of what we're doing is we are very careful of what issuers we're working with. We want issuers who we believe have a really good chance of keeping their promise to the investor, meaning they're going to work really hard to do their best to turn their investment dollar into many investment dollars, and be able to return capital with a profit or with a yield or whatever it is that they mean to do. And a lot of them have multiple bottom lines because they're impact investments. So completely with you on making this industry as clean as the large cap world, if not cleaner, because we need to hold ourselves to a very high standard for this all to work.
Yeah, I thank you for that, Andrew. And it is going to be tough. It's going to be tough because we're all going to be lured. It's already happening. We're already noticing ourselves, and it's easy to get caught up in it. To no different than the ICO craze when people would lure you this and shiny, and you go, "Oh my God, I can't!" Just this one time. So the discipline is going to be the integrity that this ecosystem has, and I'm so proud of what we've all done. I think it's just getting started, and what's happening now. It's evolving. I mean, what Reg A was when it first got started with all the bumps, and there are different bumps now, but we're working it through. We're talking about it. We're being transparent. We're having this discussion with you, Chris, whether it's for whatever reason, whether we like or not like, it's not the issue. That it's part of this. It has a role to play, and as long as everybody understands how we operate our businesses, and then we need to have some sort of accountability to it. And I think Andrew is really, accountability is going to be the next big one, and we certainly don't want the regulators touching that. We want, and because we want to protect you, the companies that are here. So listen, I usually leave the last 15 minutes, but this conversation has been really good. There's some of you there, if you got your hand up right now, put it up if you got some questions. Obviously, research is the new frontier in what's happening right now. It's going to enlighten everyone. And you can obviously go there and do the research. You can pay for it, and like any other subscriber, nothing's prohibiting you there from that perspective, so you can see it. But we are going to need to be the gatekeepers of it, because there are other sources out there that do not share that same philosophy of, they believe in educating people in a different way. So I think it's quite encouraging as we move forward, because I think this year is going to be a breakout year for Regulation A and Regulation CF. Definitely the 1 to 5 is going to be a game changer. But when I mean breakout, I'm referring to it's bringing in a brand new, different type of company on both sides, and it's bringing a brand new audience. And that is really important for all of us. In particular, Andrew, for yourself, I mean, you worked as a fund manager, so you come from Wall Street, and Wall Street at the moment has been, this is nice, guys. You guys keep playing with that kiddie world, but it's real, and it's becoming more real day in and day out. And I almost feel like this is the year they go, you know what? Start putting it on my plate. I want to know everything I can get my hands on it. And then when people start asking questions like that, you start realizing, wow, there really isn't a lot of data here into that. So that's my view, right? Love to hear your closing remarks on that.
575 is going to draw the attention of Wall Street for sure, is my opinion.
what did you call it? 575?
5 and 75. Yeah, 5
Wow.
million max for CF, 75 max for Reg A plus.
Okay,
That's
so
going
I'm
to
a
draw a
little
lot of
blind.
attention. Yeah, 575. Come on, got to get with the jargon here.
I know. You in the fives. I know you like the fives and the 75. I agree. I think this is it. This is the one, and I think it's good for everyone because they'll get to see that we're doing exactly fully compliant, and and one of the things, we're more agile, we're flexible. But we shouldn't compromise ourselves because that's the integrity they bring in, right? That is who they are. They're Wall Street. So we can be different.
I could happily say the quality of issuer at the higher end of the Reg A's that is incredible. And I think you're going to be very pleased with who you see over the next couple of months.
Perfect. And Chris, your closing remarks.
My closing remarks. Wow. Let's see.
Don't come and see me. I'll see you.
No, I mean, sincerely, thank you for having this conversation. I think it's so important. I mean, I got into this, I founded this company because I was passionate about moving this space forward, because I came from the real private equity world. I saw what goes on. I know what goes on behind closed doors. And I think there's a better way forward, especially when you can democratize access to capital for both founders and democratize opportunities for wealth creation to investors. But again, like everything we're saying here today, you have to do it the right way. It's about building this ecosystem up in the right way with the right quality parts. And we're just one part of that. Recognize our role in this ecosystem is to be that research and data layer that we're so used to in the public space. But I think it's going to be an incredibly huge year for CF and A+. I mean, the two biggest things were I can't raise enough money and I can't use an SPV. Both of those things have now been solved for. So it's like, let the floodgates open. And I'm really excited about the quality of deal flow we're seeing. I mean, my team, it's kind of crazy. We have had to hire, believe me, we've had to hire over the past 3 or 4 months. It's great. We were going from looking at 5 to 10 CF deals a week. We're up north of 30 now. And then you add an A+. I mean, it is incredible the number of companies coming to market, and it's just record month after record month. Last month, we fell just short of $30 million in CF alone, and the limits haven't been raised. So I am so excited. I do think it could be our first, $500 million year, and I kind of think 2022. And these aren't projections. It's just my gut feeling is that we could be north of $1 billion in Reg CF alone.
Yeah, it is possible because it is touching into the Series A, I think, but I think it's going to be a bit lumpy in the first few months
Sure.
because there are companies still trying to figure out their models. I mean, we do need to be, if you've done the research, you have to ask yourself this one fundamental question. If we already had 51 of them already issued prior to the increase 1 to 5, and out of those 51, only 8 were operational, so boom. And now I think there are 90, there may be 100, maybe. But the questions still remain, why? And I think, again, research is going to help. Research they're going to have a better leg up, but they're still going to be a little bit bumpy. It is going to be a great year for Reg CF. But I think from a numbers perspective, number of investors, the dollar amount of capital raised, I think Reg A is going to capital it. I'll give you an example on Reg CF. You may not know this yet, but even though the SPV has been allowed, nobody really knows how to, there is no SPV vehicle. There is no provider that's willing to take on, so the providers for SPV today are willing to take it on, 100 investors. But when you tell them 10,000, maybe 20,000 on a $5 million raise, they're like, not going to touch it. So right there, you got the top 3 SPV providers saying no go. And we're knocking on doors thinking, there's got to be a solution. But even that, there's another issue. The entrepreneur thinks that as soon as they put the investors on that SPV, they're done. And we can't, they're like, what are you, nuts? Exactly. You're not done.
Well, it's do the math. If it's $200 minimum and you're raising $5 million, you're going to have 25,000 investors. So it's the math. And, that's why I also say we've had X number of CF investors. That number for all the years we've had CF will double in 2021. Why? Because at $5 million, people can afford to hire real marketing firms and not rely on platforms which kind of do a good job to a certain point, but they're not able to scale to 5 million. Now all of a sudden you have real professional marketing. It's going to really be a major game changer. So
yeah, it is, because it's I just think, but all these dynamics, regardless, I'm all in for Reg CF. I'm excited. It's going to be a little bit. Reg A's got a little bit of a leg up because the structure is there. It's just the increase in limit and a different entrance. This one, it's got, if you didn't hear our webinar with Marty Tate, one of the lawyers that does a lot of the structuring, him and I was like deja vu. And he goes, yeah, do you remember when we were starting just at the beginning of Reg CF, nobody really knew how the first deal was going to get structured? Because you have to, people go, but it's a safe or a crowd safe. Yes, but in the early days, nobody knew that yet. Nobody knew that yet. And right now we're in the same component of SPV. We have two danger component. We have an experienced SPV operator who thinks, oh, this is great. I heard of SPV, put everybody in there. One line item on my cap table. No.
yeah, you
It
still
may
have all
look
those
like,
investors. Yeah.
thank you. Somebody's got to. So listen, great. Chris, it's good to see you. I'm glad you're having a wonderful year. Wishing you all the best. We're going to keep talking. We have more conversations that you're invited to. Thank you, everyone else, for sticking with us this afternoon, having another wonderful discussion that almost got derailed there a bit, but it stayed on track. If you want to watch it, I'm really excited to say, go to KoreSummit, www.KoreSummit.io. All the videos are there. Everyone, the ones that we did in January, all the ones in February and March, you'll be able to see the speakers, get their email address so you can reach out to them, have a conversation. Don't reach out to Chris. Sorry, bud. I got to remind everybody. Other than that, I will see everybody again tomorrow at 11:30 a.m. We got 2 more webinars for Thursday. Thank you, Andrew, Chris. Have a fantastic week, guys.
Hey, thank you. It's been an absolute pleasure, Andrew. Thanks so much.